Every generation gets sold a simplified version of investing. Buy the index, keep averaging in, wait long enough, you will be fine. And I want to say something at the beginning that many people do not expect to hear from me. That advice is not nonsense. For most ordinary people, broad index investing done patiently is still far better than chasing tips, buying stories, or paying expensive people to underperform in more sophisticated language. If you buy the market, hold it for decades, and keep adding through the noise, you will likely do better than a great many people who sound more impressive than you do. That part is real. But there is another part that also needs to be said. The game moved, and a lot of people are still playing the old map. That is what this entire discussion is really about, not whether dollar cost averaging literally died. It did not. It still works as a sensible default for long-term public market exposure. The deeper issue is whether the default strategy people were taught still gives them access to the part of the capital cycle where the most transformative upside used to happen. Increasingly, the answer is no. Let me start with the illusion. Most people never question. They hear SP 500 and imagine a grand diversified ownership stake in the productive heart of America. 500 companies, broad exposure, sensible diversification, little by little, month after month, through an index fund. It feels balanced, it feels disciplined, it feels safe, but diversification can become a story people tell themselves after the underlying concentration has already changed. When a relatively small number of giant companies drive an outsized share of the index, the emotional experience of buying the market and the economic reality of buying it are no longer the same thing. You are still buying a broad basket. Yes, but you are also making a meaningful bet that the largest names continue to dominate, continue justifying their size, and continue deserving the valuation weight the index is giving them. That may work, it may even work for a long time, but it is not the same thing as the old mythology of an equally broad, equally representative market. That is the first thing people need to understand. The second is more important. The public market no longer contains the same kind of growth sequence it used to. There was a time when a great company often came public much earlier in its life. Ordinary investors could buy into a business while a huge part of its expansion still lay ahead. The public market was not just where stability lived, it was where much of the explosive value creation was still available. That changed. The number of listed U.S. companies has fallen dramatically from the mid-1990s peak, from roughly 8,090 in 1996 to around 3,900 to 4,000 recently, depending on the data set and year you use. Phasite Phaeturn 695,334 search, Zero Phaeturn 695,334 search 5Pay, and the companies that do go public often wait longer than they used to, which means a bigger portion of the early multiplication has already been harvested in private rounds before the public even sees a ticker. That is the part most ordinary investors still have not fully internalized. They think they are early because the company just went public in many cases. They are not early. They are later than the previous generation would have been for a comparable growth story. That matters enormously. The old public market bargain was not just liquidity and broad access, it was access to earlier growth. If that growth increasingly stays private, then the public investor is walking into the theater after several of the best scenes have already been performed for a smaller audience. That is why I do not like the lazy version of index complacency. It encourages people to believe they are participating in the whole capital stack when, in reality, they are often arriving after venture investors, insiders, late private rounds, and sophisticated pools of capital have already absorbed a large portion of the compounding that used to belong to the public phase. Now ask the obvious question, why did this happen? Because being public is expensive, because being public is noisy, because founders and management teams got access to enough private capital that they no longer had to endure the quarterly performance ritual as early as they once did. If a company can raise large sums privately, why invite public shareholders, analysts, compliance burdens, short-term pressure, and activist theatrics earlier than necessary? For many founders, the answer became simple: wait longer, grow privately, delay the circus. and the private capital pools became large enough to make that possible, that changed the economics for ordinary people without their consent. They kept getting told to buy the index and stay patient. Again, not terrible advice as far as it goes. But the capital formation pipeline underneath them had already shifted. The market they were buying was no longer the same market their parents think they are talking about. Now, let us go one layer deeper. There is another illusion built into the default public market script. And it is this: the best businesses you do not see do not matter because they are not available to you. That is nonsense. They matter a great deal. The private world is not just unicorn mythology and some elite circle of impossible access. A huge amount of economic life sits outside the public index complex. Family businesses, service firms, industrial operators, boring companies with real cash flow, real customers, and real resilience. The public market wins on visibility and convenience. The private world wins on sheer breadth and on how much of America's economic plumbing never has any reason to show up in your ETF. That does not mean every private company is a gem. Most are not. It means the opportunity set is structurally different. And if you are only trained to think like a public market accumulator, you can spend your entire life ignoring the place where a lot of quiet wealth actually gets built. This is where the conversation usually becomes uncomfortable because people hear private markets and instantly assume one of two things. Either it is all inaccessible unless you are already rich, or it is a magical shortcut to riches. Both are wrong. Private markets require much more care. Less liquidity, more due diligence, more operational intelligence, less emotional laziness. They are not a toy and they are not a slot machine, but they are also not purely a trust fund sport in the way many people imagine. Capital is one barrier: knowledge, trust, structure, and negotiation are others. In many smaller private deals, those other ingredients matter more than people who have never looked closely assume. And that brings us to 2026. What makes this moment interesting is not simply that private ownership can be attractive. It is that a lot of owners and a lot of private equity-backed portfolios are under pressure to move inventory. According to McKinsey's 2026 Private Markets Work, the global backlog of buyout-backed companies held longer than 4 years is estimated at about 16,000, with average holding periods at a record 6.6 years. Faceit Fatern 748,772 search 15 Fay. That does not mean every deal becomes a bargain. It does mean there is a real structural logjam of assets that under normal timing assumptions would already have exited. When assets have to move and buyers are selective, leverage shifts. That is when informed buyers can begin asking better questions. The rich have understood something about ownership for a very long time. Public markets are wonderful for storing and compounding already accumulated capital with low friction, but private ownership, especially of understandable businesses with recurring demand and imperfect glamour, is where many fortunes are not just preserved but built. People hear private business and imagine some giant acquisition requiring 7-figure checks and a network of yacht owners. Sometimes, sure, but sometimes it is a plumbing company whose owner is aging out, a service route business with stable customers, a local operator with real margins, no drama, and a seller who cares almost as much about transition quality as headline price. That is the part ordinary people miss because they are still mentally trapped in the public market only frame. They think investing means clicking buy on whatever the brokerage app shows them. Ownership becomes something abstract and passive. They stop asking the older, more powerful question, could I own the thing itself? Now let me say something that needs saying because this is where people become foolish. Owning a private business is not buying a ticker. It is not something you do because a video made it sound exciting. It is work. It is diligence. It is financial analysis, seller psychology, structure, legal review, and very often operating competence. If you treat it casually, it will punish you more efficiently than any index drawdown ever could. So I am not romanticizing it. I am simply refusing to ignore it. That is a different posture. The most interesting people in finance are often the ones who understand both games. They respect public markets for what they do well. They respect private ownership for what it can do that public markets increasingly cannot, and they know those are not the same thing. This is why I object to the childish debate of DCA is dead versus just keep buying VU forever. The real adult conversation is more nuanced. Dollar cost averaging into broad indexes still makes sense for many people as a core base. What may be dead is the fantasy that this alone gives you full access to the most attractive part of the growth and ownership landscape. That fantasy deserves to die. Because once you let it die, your thinking gets sharper. You stop imagining there is only one respectable path. You stop treating your brokerage app as the complete map of capital formation. You start paying attention to where businesses actually live, where they actually mature, and who gets to capture what stage of value creation. That is a much better way to think. And if you want the practical implication, here it is. Public markets are where many people should keep building their liquid, diversified base. Private markets, when approached carefully and competently, are where some people may find the ownership opportunities that feel much closer to how wealth is actually built rather than merely stored. Those are different objectives. You should know which one you are pursuing. I would never tell an ordinary person to abandon a sensible index program for a fantasy of buying private companies they do not understand. That would be irresponsible. But I would absolutely tell them to stop pretending the index is the whole picture. It is one picture, a very useful one, a very incomplete one. If you are younger and building capital, the best first lesson may still be discipline, automatic investing, and public market patience. If you are further along, have operational talent, relationship capital, a real appetite for diligence, or a serious desire to learn how businesses are transferred rather than merely traded, then the 26th of May be one of those periods where looking beyond the public screen becomes more than an intellectual exercise. It becomes a real option, because the window that matters here is not just valuation. It is seller motivation. It is an aging ownership base. It is a private equity system with inventory pressure. It is a world where high rates and longer holding periods have made patience and structure more valuable than hype that creates openings, not guaranteed riches openings. And openings are enough for people who know how to prepare. At the end of the day, I still like the index for what it is, a low-cost, rational, humble way to own a broad piece of productive enterprise. But humility becomes passivity when you use it to avoid asking whether the best part of the game has changed fields. It has public markets are still useful. They are not the whole story. The rich did not become rich because they hated public markets. Many of them became rich because they learned where passive allocation ends and direct ownership begins. That is the decision sitting in front of more people. Now, do you want to remain only a buyer of what is already liquid, already packaged, already weighted, and already widely owned? Or do you want to at least begin learning how ownership works before the ticker symbol exists, or in places where it never will? That is not a small question, and I think 2026 is one of those moments where asking it honestly matters more than ever.